In 2025, 79% of professional Wall Street fund managers, people with Ivy League PhDs, 80-hour work weeks, and million-dollar algorithms, just got absolutely crushed by a piece of boring, passive computer code. Let that sink in. They spent their entire lives trying to outsmart the market, and they lost to a script that blindly buys the biggest U.S. companies and then takes a nap. If you want to turn $10,000 into $500,000, you absolutely do not need a complex trading strategy, a guy in a custom suit, or a secret tip from a finance influencer renting a Miami penthouse. You actually need to do the exact opposite. Today, we are breaking down the lazy strategy that is quietly crushing the professionals and exactly how you can turn doing literally nothing into a $500,000 reality. $10,000 feels like a lot of money until you try to retire on it. Then it feels like pocket change. It is easy to log online at midnight and convince yourself the only way to catch up is gambling on high-risk plays. We are conditioned to think wealth requires intense effort. We think the guys with the Bloomberg terminals have a map to a treasure that you aren't allowed to see, but the data proves that map is entirely fake. Imagine a giant neon scoreboard on Wall Street publicly flashing the win-loss records of every high-paid financial wizard. It actually exists. It is called the SPIVA scorecard, and it tracks how these professionals perform compared to simply buying a basic S&P 500 index fund. The S&P 500 is just a basket of the 500 largest profitable companies in America. Apple, Microsoft, Amazon. The 2025 SPIVA report is a bloodbath for the finance industry. Zoom out to a 10-year timeline, and a staggering 84% of active managers fail to beat the market. 8 out of 10 geniuses lose to sheer, unadulterated laziness. Keep this massive failure rate in mind because it is your best defense against the trap we are about to discuss. Why does the entire financial industry try to convince you to pick individual stocks or pay them to manage your money? Because the industry does not make its billions when you sit still. They make money when you move. They build fortunes by setting up invisible toll booths across your portfolio, draining your returns with hidden mechanisms like 12b-1 fees. That sounds complicated, but simply put, it means they force you to pay for their firm's marketing budget straight out of your own retirement account. Or they slap you with a front-end load, skimming up to 5% off your deposit before your cash even enters the stock market. Imagine a Vegas casino. You sit at the blackjack table, and before the cards are dealt, the dealer takes 2% of your chips just for sitting there. Win or lose, they take that cut every single hand, every single year. That sounds complicated, but simply put, it means that even if your actively managed investments somehow do well, the fees are quietly eating you alive behind the scenes. Let's say your investment earns 7% a year. In a low-cost, lazy index fund, your expense ratio is around 0.03%. That is practically zero. But give your money to an advisor pushing mutual funds, and you might pay a 1% management fee plus another 1% in fund fees. That 2% difference sounds like a rounding error, like leaving a bad tip, but over 30 years, that tiny percentage point will cost you hundreds of thousands of dollars. You are literally buying your broker a beautiful home in the suburbs just so they can perform worse than an index fund you could buy on your phone while sitting on your couch in sweatpants. The system is rigged against effort. But right now, you might be looking at the news and thinking, the market is at an all-time high. Is this really the time to invest? The S&P 500 has been soaring, and there's a very famous metric called the CAPE ratio. It measures how expensive stocks are relative to their long-term earnings adjusted for inflation. Right now, the CAPE ratio is sitting at roughly 40. The long-term historical average is around 17. That sounds complicated, but simply put, it means the stock market looks wildly expensive today compared to the actual profits those companies are making. Historically, the only other times the market has been this expensive were right before the crashes in 1929 and 1999. When people hear this, they freeze. They move their $10,000 into a savings account and tell themselves they are going to wait for the dip, they're going to wait for the crash, and then they will buy in. This is the biggest psychological trap in personal finance. Trying to time the market is a fool's errand. When the S&P 500 goes up 25%, the average investor only makes 16%. Why? Because they put in too much effort. They panic, they sell when the news gets scary, and they wait too long to buy back in when things recover. Here is a terrifying number. If you had invested in the S&P 500 for the last 30 years, but you tried to outsmart the market and accidentally missed just the 10 best days over 3 decades, your overall returns would be cut strictly in half, just 10 days out of 10,000. And here is the kicker. Those 10 best days almost always happen right in the middle of a massive panic, usually during a bear market when every headline screams the economy is collapsing. By waiting for the dip, you are guaranteeing that you miss the exact days that actually make you rich. So if picking stocks is a scam and picking the right time to buy is a trap, what actually works? How do we turn this 10 grand into $500,000? We use the lazy strategy. The math of compounding is the only proven financial miracle on Earth, but it requires fuel and it requires time. Let's imagine you were 41 years old. You've been working solidly for 2 decades, driving a sensible older sedan, and you just scraped together $10,000 from a work bonus and a tax return. If you lock that $10,000 into an S&P 500 index fund and treat it like a buried time capsule, walking away while it averages an 8% annual return, it will take a grueling 40 years to cross the $500,000 mark. You would be blowing out candles on your 80th birthday. A 4-decade wait isn't a retirement plan, it's a financial life sentence. Doing nothing is great, but we need to supply the initial spark. The entire equation flips the moment you provide a steady stream of oxygen, a completely hands-off monthly contribution. You do a ruthless audit of your spending. You ditch premium cable, swap meal delivery for Sunday prep, and extract $450 a month in freed cash. You take your initial $10,000 and you set up a one-time trigger to transfer that $450 into your index fund every single month. Then you absolutely refuse to touch it. By year 2 of intense laziness, you're sitting on $22,000. By year 6, you're hovering near $55,000. This right here is the danger zone. Psychologically, you look at the balance, realize you have been brutally disciplined for over half a decade, and you still don't feel rich. It feels incredibly unrewarding. But if you push through that plateau of boredom, something incredible happens right around year 10. At year 10, you are sitting on nearly $100,000. And more importantly, that is the year your money takes over the heavy lifting. That year, the interest your portfolio earns completely on its own is larger than the total amount of money you contributed from your paychecks. Your money just got a full-time job. By year 20, you are closing in on $300,000. By year 26, you cross the $500,000 mark. You turn $10,000 into $500,000 without ever reading a corporate balance sheet, without ever timing the market, and without ever paying a Wall Street advisor a single dime. But why aim for $500,000? This brings us to a concept in personal finance known as coast fire. That sounds complicated, but simply put, it means reaching a portfolio size where your money is growing so fast on its own, you can literally stop contributing and still retire wealthy. Once your portfolio hits $500,000, you have reached a critical escape velocity. Historically, invested money doubles roughly every 7 to 10 years. That means even if you completely stop adding that $450 a month and just let that $500,000 sit there, it turns into $1 million, then $2 million. This is the point where you take your foot off the gas. You can take a lower-paying job that you actually love. You can stop trading your physical health for overtime pay because the financial heavy lifting is officially done. The secret engine behind getting to that point is a concept called dollar cost averaging. That sounds complicated, but simply put, it means you buy the exact same dollar amount of an investment on the exact same day every month, no matter what the stock market is doing. This is why the lazy strategy actually wants the market to crash. Think about a grocery store. If your $10 coffee goes on sale for $5, you don't panic and scream that the coffee market is crashing. You buy as much as you can. When you blindly invest $450 a month and the stock market drops 20%, your money suddenly buys 20% more shares. You are scooping up Apple and Amazon on clearance. When the market inevitably recovers, those extra shares you bought on sale explode in value. While active traders panic and sell at the bottom, your lazy system is quietly buying the dip for you, devoid of human emotion. So, how do you execute this today? Step 1 is selecting the right vehicle. Open a brokerage account with a low-cost provider like Vanguard, Fidelity, or Charles Schwab. It takes exactly 4 minutes on your phone. Step 2 is buying a broad index fund. Look at options like VOO or FXAIX. The only metric you care about is the expense ratio. You want 0.05% or lower. Remember, an expense ratio of 0.03% means for every $10,000 invested, you pay $3 a year in fees. That is less than a fast food cheeseburger to own a piece of corporate America. Step 3 is the most important part: weaponizing your laziness. Set up a recurring transfer so the exact day after your paycheck hits, your money is instantly transferred and automatically invested into your chosen index fund. You do not wait to see what is left over at the end of the month, because the answer is always zero. You pay your future self first before you can spend it on Amazon Prime garbage you don't need. And step 4 is mastering the psychological barrier. You have to aggressively ignore the news. The financial media exists to sell advertisements, and fear gets the most clicks. When the market drops, and it will drop, the headlines will scream that a recession is here. Your friends will tell you they moved everything to crypto. Your coworker will brag about some penny stock that just went up 300%. You have to smile, nod, and do absolutely nothing. The biggest threat to your $500,000 goal is not the Federal Reserve. It is the human temptation to log into your account and hit the pause button because things feel a little shaky this month. There is no prize for making your financial life complicated. There is no trophy for experiencing the maximum amount of stress. The people who actually build generational wealth in America are not the guys screaming on financial television. They're the people driving 10-year-old cars, living in modest houses, who set up a system in their 30s and fiercely ignored it for 3 decades. The entire Wall Street machine is designed to make you feel inadequate, to make you feel like you need their expensive guidance to survive. But the math strips away the illusion. Building wealth is not about timing the next big tech stock or decoding inflation reports. It is about buying a single, boring index fund and having the sheer willpower to leave it alone. The reason this strategy is so powerful isn't just because it makes you rich. It is because it gives you your life back. Every minute you spend stressing over stock charts is a minute you aren't spending with your family, building a skill, or just enjoying the life you are working so hard to fund. You have total permission to be the boring one. In a culture that worships the short-term hustle, playing the long game is the ultimate rebellion. The smartest move you can make isn't picking the next big stock. It is building the machine that makes you wealthy while you sleep. Your grounded next step is incredibly simple. Tonight, do not scroll social media for another hour. Spend exactly 10 minutes logging into your bank, setting up that 1 monthly deposit to your brokerage account, and then go live your life.